Hey everyone, Chris Lopez here. Today's podcast is actually a snippet from our Portfolio Analysis Mastermind that we started in early January of 2022. We started the PA Mastermind with one goal of helping investors around Colorado figure out what to do with their portfolios. We've done a lot of education on how to analyze a property, how to buy a property, but after you've owned a couple properties, and especially once you tied in with the market the last 5-8 years, even the last couple years of crazy appreciation and crazy rent growth, you have different opportunities. The deal you bought 9 years ago is no longer the same deal. So the question becomes, what do you do with the property? Should I pay it off? Should I refinance it? Should I do nothing? Should I sell on 1031 trade up? It gets very nuanced and there's multiple doors to go through. And that's exactly what our Portfolio Analysis Mastermind we created to solve that problem, to help give investors a clear picture as to what they needed to do. So in this mastermind, this is a snippet where we had Ben Einspahr go through his portfolio, which is a couple house hacks here in Denver and a out-of-state property bought a couple years ago as a nomad property. So good portfolio and very representative of a lot of people around Denver. So we analyze it using the Property Llama software, and we also have a great panel on this discussion. It's myself, Joe Massey on lending, Chelsea Scott on investing, Richard and Lona talking about the software and other investing techniques. So it's a great discussion. Please enjoy it. And if you have questions on your portfolio, reach out to us, and fill out the investment consultation. You can get in touch with me or Chelsea. We'll plug your property in the software, review it, and help you figure out what to do. So enjoy the show. All right, so moving on here to some portfolios. Ben Einspahr is in the first hot seat. So yeah, grab the microphone,
Let's
Ben.
hear it, Chris. What do you got?
Yeah. So before this, Ben's like, well, what questions asked me? I was like, no, Ben, that's the way it works. So this is all live. I have reviewed it, but Ben has no idea what's coming.
Nothing
So
at
we'll
all.
try to keep it as real as possible.
Yeah.
Because Chelsea and I both do a lot of portfolio reviews. So does Joe. The reactions you get from people is always so, I find it motivating and intriguing. We're like, oh my gosh, this or that. So we want to try to replicate that on air, doing it live. So here is Ben's current portfolio. He owns 3 properties, an out-of-state property in Omaha, your first house hack in Arvada, and your current house hack in Wheat Ridge. But we're modeling this after you move out of your Wheat Ridge property to give us a more accurate view of your whole portfolio. So that's kind of the one caveat, which is a little nuanced on here. But we're assuming this is once you move out of your Wheat Ridge property, which is what you currently house hack.
Okay.
But you're going to move out of that under this assumption.
Okay.
You good with that?
Yes, sir.
So overall with the portfolio, did you realize you own about $1.4 million in real estate?
I did not until I put my properties into the software. Then I looked at it with my wife and I said, holy cow.
Pretty badass, isn't it?
Yeah, it's pretty crazy.
I felt pretty good about myself.
You should.
I know.
Yeah.
Yeah, we made the software and we had the same response when we put in our properties.
Yeah.
I was like, wow, this is my portfolio.
Yeah. I honestly was like, Allison, come down here. I gotta show you something.
I was like, this is unbelievable.
What was her reaction?
She just was eyes wide open and very happy that we came across this process and this method of house hacking and generating wealth through low down payment.
Mm-hmm. Your total equity, $360,000. That's a lot of money in your real estate piggy bank.
Correct.
Yes. About $77,000 NOI, about $22,000 annual cash flow. Now, here are the metrics we like to look at. Your loan to value is about 74%. So extremely high, which higher leverage produces greater returns.
Okay.
It also swings both ways.
Yes.
In the current market with rents and prices increasing, leverage is your friend.
Yes.
Cash on cash is 22%. Your average cap rate is about 5.6%. So overall, I consider this a very well-performing portfolio. High LTV, a very solid cap rate. What are your guys' take on here?
I have a question.
Let's hear it.
You have $360,000 in total equity. This is going to take you back a little ways. Do you remember the approximate amount of money that you spent on down payment for all 3 of these
I want to know
properties?
too. That was right on my mind.
Yes, I do know that. Give me a second. Give me a second.
Bring in the calculator. All right.
Hey, play the Jeopardy music.
Yeah, okay.
That's gonna make it so much longer.
$1, Bob.
All right,
Just a ballpark.
Let's look at it.
So, Omaha property, let's say 15,000.
Okay.
So that was a house hack or
That
a
was
nomad.
That was just I bought it as a primary residence
Yep.
before I even knew about real estate. So
But
I'll
you-
call it excellent.
So owner occupied.
Yes.
So 15 grand in.
15.
Don't hold me to that. Hold
That's
me to
Okay,
that
good
50.
enough. It's good
Ballpark.
enough. It's good enough.
Third.
Property.
Arvada house hack.
Including, let's say, okay, so now including furnishings and
Yeah, I'd say
renovations,
your
yes.
cost basis, your cash
cost.
in.
How much are you in?
Yeah.
35
30. So
Okay.
15 to
So
35 is
50.
60.
and
Oh,
45K for the other
50.
one.
50.
Don't do public math.
Whoa.
Don't you have a
all right.
degree in calculus?
Okay.
Wouldn't you just tell me?
Probably should know that.
Right?
Yes, correct.
45, 35. I'll do a real check on it to make sure that we're
And sorry, what was your Wheatridge property?
95,000.
Yeah, 95.
I got
45.
distracted
I'm
by
be-
helping Joe with his math.
And keep in mind, these numbers are
It's
the
arithmetic.
last thing I want to do is give false numbers. So these are higher than.
Yeah.
So you've
these
made
are very conservative numbers.
so you've made 200%. At
You've
least.
invested $95,000.
Yeah.
Correct.
And you now have $360,000 in equity.
Oh, so
Yes.
that's more. That's like
It's almost.
okay, 260%. Well,
Yeah.
luckily, yeah.
I just wanted to touch on that because I think that's a number that we miss sometimes as we forget you put in some capital.
Yeah.
And you now have a return of that capital in the form of appreciation or now equity, $360,000. And while those properties were appreciating, you were also getting cash flow. Is that correct?
Cash. Well, yes and no, because I'm house hacking. I still have a mortgage payment that is, let's say, $500-$600.
Okay.
But when I move out, yes, 100% cash flow while I'm living there. I'll call it cash flow because what would rent cost? $1,500. I'm
Right.
paying $500.
Mhm.
That's a win in my book.
Awesome.
That's the power of real estate and just the great market that we've been in.
Mhm.
Thank you
Time-
for letting me derail that.
no, that was great, and that's a great point. As
No,
the
I
power
wanted
of the
to
house
know.
hacking.
Yeah, that was right on. Yeah.
Yeah, and all these were with 5% or under down payments.
So, quick question here from Shelly. Ben, how did you determine the current valuation on each property? I actually don't know, so this is a great question.
I did a mixture of Zillow, just the typical things. If you Google it, that's where I found all the evaluations, but I did it on a very conservative level. The last thing when Chris told me I was going to be on this, I didn't want to say, oh, property 2, 625,000. I was very conservative with the numbers. So just say Zillow.
Which is great for ballparking, which is kind of what we need now. And of course, if you guys want like a CMA, comparative market analysis, let us know or let your agent know, us or he or she can run them for you. But Zillow, Redfin are great ballpark. I kind of lean more towards Redfin than Zillow for their estimates. But this is just a ballpark. In reality, you're probably 15 to 20% higher since that the market
Really?
the market is freaking crazy right now.
Zillow's algorithm can't keep up.
Holy cow.
Well, I mean, the offers are putting right now, the majority are 5 to 25% over list right now.
Well, I knew that they were over list. I just wasn't sure if the Zestimate and everything had captured that. Because yeah, okay,
No,
They can't keep up.
interesting.
no. So okay. So overall, I think we can say this is a very well-performed portfolio. Any people that want to debate that?
No, it's a
What
really
value
solid
adds
cap
do you
rate.
see?
No, it's a really
Oh,
solid cap rate.
whoa! Don't get ahead of the slides here, Ben.
Yeah.
Oh, I don't know.
He's leading the way. He doesn't know what's coming
I didn't know. I haven't seen these slides, and I just want to. That was a question. I had.
Well, prepare yourself, Ben. So we got Ben's property number 1. This is the house hack in Arvada you bought 2, maybe 3 years ago. Yeah.
April 2019.
Cool. So it's a main house, 3-bed, 2-bath, long-term rental, ADU 1-1. It's a short-term / medium-term rental. But here's the great thing. It's an 18% cash-on-cash return, a 5.2% cap rate. Ben, what's our threshold for the rule of thumb on cap
4?
rates? 4%. Are you above or low?
Above
Return equity is 16%. What's our rule of thumb?
10%.
So you're above it. LTV is 68%. What's our rule of thumb?
I don't remember.
10%. Or I'm sorry, 50%. for that.
50%. Sorry.
These are a lot of times my rules of thumb, just to clarify, as to what I use and I've gathered from people smarter than me.
Heuristics. Well, it's a simple rule. Yes.
Okay.
Yes.
I don't know how to spell that word, but we're good.
HEU. No.
So here's the thing with this property. Like, it's a great cap rate property. I mean, finding, low to mid 5 cap rates it's getting tough from this market. There's not like an obvious upside. We can get something greater. So in my opinion, no optimization needed. You can't squeeze out much more equity on here since this is a rental property now. Joe, what, maybe a 75% LTV from you?
Yeah, you could take cash out to 75% LTV, but you'd have a little bit of cost associated. You'd get very minimal cash. I don't think you do anything.
And what's your interest rate right now on the loan?
Interest rate is 2.75.
What's a investment cash out refi right now, Joe?
4.25. Don't do anything.
Yeah.
Not with a loan anyways.
Okay.
And even if you try to
Stay
do a
right there.
HELOC, I mean, 70% LTVs, 70% combined LTVs,
Yeah,
highest I've seen from a lender.
You'd get 12 grand.
Yeah.
And you're not saying sell it and put it into a higher performing asset either?
I don't think so. A
No.
5.2 cap.
But
16.
I'm self-managing it. So I'm self-managing 2 properties right now, a medium-term / short-term rental and a long-term rental. What if I sell it, 1031 it into just a standard rental?
I think you're going to lose some cash flow if you were to do that, because your short-term and medium-term rental is going to give you I don't know what the right word is, but
Above
oversized,
average.
above average. Thank you. Above average cash flow.
Yeah.
So if you're managing yourself, I think if that's a pain point, we need to talk about a property manager, right?
Yeah.
Let's keep the property and let's pay somebody $200, $300, $400 a month, whatever the number is, to manage it and remove that pain from you for $400. Eric Ross would be happy to take this over, and you could spend your time, the 3 hours or 4 hours a month you're managing this,
Yeah.
doing something else.
One point though is I think that would drop the cap below 5.
That's a good point.
It would drop it
Yeah.
by about 0.7, 0.8 is usually what it
So
does.
he'd be a
Yeah.
low 4s.
So it'd be a low force.
And I don't think Eric does short-term rentals as well. So that's a whole
Exactly.
different. This
And-
is
or
where-
medium-term rentals. It's
Yeah.
like, if anyone knows of a good medium-term rental property manager, please connect with me.
So my recommendation is no optimization is needed. It's a great property. You have a high LTV. You could sell it, trade up, but you'll pull out some equity. But like once you start factoring in some like finance, like higher interest rate, I would hold this as my gut reaction. I see Joe nodding, Richard
agree.
nodding, Chelsea nodding, Alona's nodding. All right,
Okay,
so
cool.
we'll hold that. There was one question I wanted to answer from Justin. Was the ADU already there?
Yes. The only thing I did, it was outdated, and I completely gutted, remodeled the bathroom, and updated the kitchen.
No, you got rid of I think I would call it puke green tile was kind of
Yes,
the core.
we did do a podcast. We did do a podcast on this
The
that we can
Is
link.
that a
70s
60s?
special?
Yeah,
Yeah.
is that a 60s or a 70s?
That's a
vintage?
Home Depot paint color right there, by the way.
Yeah.
Puke green. So
Custom.
Hold that, do nothing. Ben's property number 2, which is the new build townhome you bought about a year ago.
Yep.
With your wife and now your daughter Emma. So we are assuming you move out of here, and I think in a year or 2 is kind of your plan, right?
Yeah.
So just for some place, like it's very hard to model like a house hack in the software.
Well, he's excited about his
He just saw the numbers.
Whoa, calm down, Ben.
He's like, wait a minute. 41% cash on
Hold
cash.
on. 6.7 cap rate. I didn't see that.
Yeah, so
Yeah.
I had the same reaction when I looked at this too, Ben. This is why we do this live. So we're at a 6.6 cap rate. We're at a 44% return on equity and an 85% LTV. So when you hear the LTV and ROE, your reaction might be, how the hell is the ROE and LTV so high? Well, you bought this property 5% down 12 months ago, right?
And I prepaid PMI.
You prepaid PMI as well.
Correct.
So this is why we're seeing very high numbers.
denominator's so small on what he. Yeah.
So Chelsea's off mic. She said the denominator, which is down payment, is so small, and that's why we're seeing high returns.
Yep, and that's the same for that 10-year forecast concept.
Yep.
And
And
this
this
is-
what we talked about earlier. Yep.
normal with house hacking. to have it.
Absolutely.
Yes.
Yeah.
And this is why, as a total side note, if cash flow is a little negative or not that great, look at the total return, because in my eyes, cash flow is not that important as long as the numbers work out, because you get these
Especially at his
insane
age.
returns. So yeah,
Yeah.
Because our average mortgage right now is, I would say, $1,000. But when people house hack, they're like, I want to cover my mortgage. We're not covering our mortgage, but it's still a win in our book.
Yeah, totally.
You got to pay to live somewhere.
well,
If
if you
you
have a
weren't
job,
living here, you would have to have an apartment.
We're in a
Right.
new build townhome for under $1,000.
I do have one question on this, because this is clearly an extraordinarily good deal.
Thank you.
Where did you find it?
MLS, right off the MLS.
Could you say it one more time?
MLS.
Thank you.
How do you spell that?
The multiple jurisdictions.
Multinational. No.
So I think this is Eric here on the Facebook user. He says, we can help midterm depending on the situation. Would be happy to chat. So
Cool.
I learned something new. So chat with Eric. I'm assuming that's the Facebook user on there. Megan Hunter said, is this property a side-by-side duplex? No, it's not. It's a new built townhome, 3 stories. Entry ground level is the Airbnb suite. We have a podcast on there that we can link in there as well.
But is it
It's
A
a six.
du- you
It's
do have a
actually
shared
six
wall?
black. Yeah.
Okay.
So we're on. We chose the far end. We were one of the first.
Oh,
to
so
come
you
up.
only have one wall. Oh, that's
Yeah,
good.
we're only one wall. So we're on the. Preston convinced us we wanted to save the money and purchase one of the middle ones, but we got one of the larger end walls. So we only have one shared wall with a bigger
yard, kind of. Yeah.
shared yard, but with a separate entrance as well.
And more windows.
More windows, light,
More
bright.
lighting.
Who
Yeah.
doesn't love light and bright stuff?
And I agree with Preston convincing you as you
He
said
did
it.
an excellent job, and that's the value of having an investor-friendly real estate agent.
All right, so moving on, just kind of keep an eye on the
Yes.
clock here. Ben's property number 3, and this is I kind of ordered these so we'd have more talking points. So this is the first property, or the
Yeah.
oldest property in your portfolio in
Yeah.
Omaha, Nebraska, that you bought for about $15,000 down. And this one, I did have some comments on here. It's a 4.1% cap rate, and you are self-managing this, right?
Yes.
Okay, so if you had a property manager, it would be below a 4% cap rate. And that's something, as we look at these rules of thumb on here, property management will swing cap rate 0.5 to 0.8% is usually what I see.
Mhm.
So keep that in mind. There's no right or wrong, but adjust for that accordingly. Your loan to value is 58%. Your return equity is like 9.9%. So a lot of borderline metrics here, which is not good or bad, but kind of warrants, hey, let's peel back the onion some more.
And also, it's out of state.
Yes.
I think that's a
Oh,
major factor to depending
It's a
on what you
pain
want.
point.
Yeah.
Do you have a manager on
No.
this? Okay.
I do it myself, but we've had a tenant in there for 4+ years, so I haven't had to deal with turnovers.
Okay. Positive.
How much under rent are you? Or are you under
let's-
market rent?
Under-
Under market rent, let's say $200 per month.
Well, I can make the case that property manager would pay for himself or herself then at that point, potentially.
I can't argue with that.
But I noticed on this, so your metrics are borderline. Your cash flow is slightly negative. But here's, I highlighted this in the red in the lower right. You're paying PMI on here. Where is this an FHA loan?
Yes.
Okay, so with FHA's, Joe, PMI never drops off, right?
Correct. It stays for
Yeah.
the full 30 years.
Whoa.
Okay. So potential there, you could refinance, but you're at 3.75. So I don't know, if you get an FHA at 3.75, now investment property, Joe.
Well, so here's the catch. The interest rate on this loan is 3.75, but that mortgage insurance costs 0.85. All right. That means you have an effective interest rate of 4.6. All right. So you could take cash out of this. I happen to be licensed in Nebraska, by the way, at an interest rate of 4.25% and borrow up to 75% of that value. So if you really like this property, you could take cash out of it, use that cash to buy another property, use that cash to add an ADU to one of your other properties, use that cash to spruce up something, whatever you want to do with the cash. But I think Chris is going to talk about this. I don't necessarily know when you look at the gross rent multiplier of the rent divided into that current value of the property. I don't know if it makes sense to keep this property from a monthly rental compared to price standpoint. Chris?
First off, Joe, you redeemed yourself with that math from adding simple addition earlier. That was impressive on the PMI calculation.
I can only do
so-
calculus. I can't do
Yeah.
addition.
No
subtraction.
arithmetic. The degree is not in arithmetic. It is in calculus.
So I mean, Joe basically did their, hey, he calculated how much the PMI is costing. You said about a 0.8% of interest rate.
0.85.
Okay.
Yep, per year.
So really it's about a 4.5% actual interest rate.
Correct.
Okay. Which is a really good reference point since we think in interest rates. So I agree. Hey, you're borderline. Richard brought up a great comment. This is out of state.
Yes.
Joe brought up a good comment about, your loan to value and performing. Based on these numbers, probably doesn't make sense to do a cash out refi. So what I see here is a huge potential for deploying equity since this is not a great performing rental and it's out of state. So when you look at like borderline properties like this, you have to kind of look at other considerations. If you were to keep this property here, what's the appreciation rate right now in Omaha, Nebraska? Get your
And on a
guesstimate.
40, like, are we talking 40-year average or?
No, right now. What do you think the next couple of years will be like?
3 years, yeah.
I mean, we know Denver, front range, we're at 13 to 30%.
Low doubles, yeah.
11%.
Okay.
Oh, that's not bad.
So that'll be one consideration I have on there because I don't know the market, and I will first.
It's not bad. It's
okay.
not
Yeah,
almost
it's not
not
bad.
bad at all.
Okay.
That's really good,
Which is-
historically.
Which is one thing to keep in mind, and also like long term, do you want out of state rentals? And that's more of like a you and Allison as investors. Does that change? Hey, we don't have properties locally, or do you like out of state properties?
And
these
do
are
you
just-
like that market?
Yeah.
Like, do you have a reason why you like that market?
I like the market, but I don't like out-of-state rentals.
And
And
we
we
will
want-
like the next slide, Ben. So what I proposed here,
Let's hear it.
I grabbed, this is a deal that Jenny helped a client buy, I think a few months ago, a Colorado Springs townhome. They got it right around $250. So I bumped up the value, the purchase price, bumped up rent slightly to kind of adjust for the last, 3 to 6 months.
Bless you.
Thank you.
So I would say, hey, sell the Omaha property, utilize a 1031 exchange, and buy in the Springs. So that's my thesis here for this portfolio. You're selling Omaha and you're buying a comparable property here in the Springs. And I kept it specifically below how much equity you had on there to be conservative.
And that's a reasonable estimate for the Springs because I invest down there.
Yeah, these
Yeah.
these properties are available down there.
Yeah.
Okay, so I love this, Chris. I think this is an awesome
thank you.
assessment. You're welcome. Because one, you and I both were just talking with a client yesterday who was asking us about a property in Tahoe, and we both literally had the same analysis without even realizing it, and had said that once realizing that this client uses that property in Tahoe and it's somewhere that they visit, to me, that's gold. That's absolutely gold. If it's somewhere that you want to use now,
And it doesn't show
out
up on
of
a
state,
spreadsheet.
it's not. It's off the spreadsheet decision making. And so if that's something that you want to use in the future or currently as either a short-term rental for yourself or a property you're just going to visit, absolutely out of state makes a lot of sense. I had a conversation this morning with Megan, who just chimed in a few minutes ago, who also has some out-of-state properties that she's not as keen on because she doesn't use them and doesn't plan on ever using them. Ben, it sounds like, has a similar reaction. He doesn't like having out-of-state properties. There's a very good reason. I have an out-of-state property. We use it and we plan to use it in the future. That is the whole purpose of that property.
Yep.
If it's not something you love and the market isn't 10xing what's happening here, which is really hard to do, very few markets are really seeing the appreciation and the rental increases and the immigration that Colorado's seeing.
Just overall fundamentals on the city.
Just basic market stats, basic market analysis. Unless there's a justification there or there's a personal reason, I couldn't agree more, especially as you go down the line. Think of yourself in 5, 10, and 20 years from now. Do you really want to have the hassle of there are termites, there was mold, and I have to fly out and out of this property in a place that you're not tied to personally and have to manage that? So obviously the numbers are great here, but also it speaks to your concept of wanting to bring things in. The other thing is, another conversation we just had with some clients was this ballot measure 2F about how many unrelated people can occupy one particular home. Very relevant for house hackers. It just failed miserably by 70%. But we know that because we live in this market. We can follow what's happening with short-term rentals, with medium-term rentals, with what different municipalities are saying. So if you have multiple out-of-state properties, that's really hard to follow.
You took my talking points, Chelsea. So no, that was awesome. Like, thank you. Great minds think alike. I mean, that was exactly what I was going to say. Because those are considerations to make. So rewind that and listen to what Chelsea said the last 2 minutes. So I estimate an all-in purchase price of $70,000 to $75,000 to account for down payment, some closing costs, depending on point buy down right now with interest rates. $265 was I increase the purchase price to 4.25% interest rate at 25% down, Joe.
Spot on. Yep.
Okay, and we could do a lower down payment on this property since it's a townhome, correct?
Yes, you could do 15% down. The trade-off, you have a slightly higher rate, slightly higher
PMI.
closing costs, and mortgage insurance. And so that's something that we do with every client as we sit down and look at, here's a 15% down option, here's a 20% down option, here's a 25. And then, 15% down option is not going to cash flow as well, obviously. But sometimes we like to do that if we're spreading out over multiple properties. So definitely there's options here, but I agree with the analysis of 25% down.
And I we always like to model conservative so we can plan out. So that's my assumption here. You sell your Omaha property, and you'll probably have some extra equity in there. But again, I'd rather underestimate than overestimate. So here are the two portfolios I put on here. The top one is Ben's current portfolio after he moves out of the Wheat Ridge property. The second is titled PA Mastermind Scenario, Sell Omaha and Buy a Townhome in the Springs. One last comment I actually want to make here on the cap rate on this townhome is I got it at 5.5%. My assumption is that Ben will self-manage. Since you're self-managing other properties and this will be a long-term rental, I assume you will self-manage this. Otherwise, it would be a 4.8 cap rate PM.
In Colorado Springs, you get mid-4s.
Okay, yep.
Yeah, usually.
So on the upper right here, I kind of just did a cheat sheet for LTV, and this is portfolio-wide. Your portfolio goes from 74% to 76% LTV. Cash on cash drops from 16 to 12.5. Your blended cap rate goes from 5.6 to 5.8. Your total portfolio NOI goes from $76,000 annual to $83,000 annual. Your total valuation goes from $1,375 to $1,430 million. So you can see the green here. We got 4 green lights and 1 red light, to be very simplistic. And you guys can read these in detail later. So my analysis is not a huge jump, but a solid improvement. Like, this is not going to be some crazy, oh my gosh, this 10x is your portfolio, but it's, it's 3 steps forward.
Yeah, and then you compound that over 15 years, though, and then that actually does become pretty big.
Amen.
Even 5 years.
Yeah, exactly.
So, one question is, do you want to own long-distance properties, which is what Chelsea made a great point a few minutes ago. The other thing is, which market has more upside? I know, cash flow is a huge metric we look at, but now with how Colorado and the majority of markets are around the U.S. is, appreciation and future rent growth is a metric that I'm a lot more bullish on and focused on than like just today's values, because I think that's realistic. So these are questions to ask yourself, Ben. Do you want to own in Omaha for the next 10 years, or do you want to in the Springs for 10 years? Not right or wrong answer.
Can I just make a comment here?
Yeah.
So I want to bring up again my conversation with Megan. So she has some properties in Louisville that have just absolutely skyrocketed on rent because of the fires. So, not necessarily the happiest story, but at the same time, she has properties that she can offer, and people are now in them at an accelerated rent rate. Why am I mentioning that right now? Because locational diversity is something I really believe in. Out of state diversity is not something I believe in. So just to kind of like really clarify that, having some properties in different parts of the metro, of different parts of maybe Colorado Springs, Pueblo, other markets within a car ride away, I think can be a great thing. A lot of people saw gigantic bumps in vacation properties in the mountains and other places within Colorado during COVID. So my point there is that from a management perspective and from an overall looking at your own portfolio, going out of state can cause a lot of challenges that having locational diversity within state is still achievable though.
I agree.
So I'm going to show up some comments on here. I'm going to go around the round table, and I want one simple answer. Would you keep it or would you trade up? So think about that for the next 30 seconds, panel, and you too, Facebook. But 2 great questions here is from Facebook user. How is the Omaha property cash flow negative? Rent is $1,400 and payment is $750.
Maintenance.
It's a higher percentage of the rent.
Yes, I'm not there to do it myself, and I've had a lot of big cap X's happen within the past 3 years that I made sure to put in accurate numbers, and it put me at a 15 to 16% maintenance budget.
Yeah, I noticed that it was a double-digit maintenance than lower than we normally do here in Colorado.
And it's
Pro
been
forma versus actual. It happens
and
sometimes.
and that's the challenge of out-of-state rentals.
Yeah.
I have a question as well. How much is the insurance and how much are the property taxes on that home?
Insurance and property taxes. Property taxes are 20.
I might have this. We might have to answer that later. I might have that. No, I don't have that.
Here's what I'll know.
The question was made
24
for-
year.
Anyways,
The answer, a $210,000 property has roughly $2,400 in property taxes, right? What is the equivalent of $2,400 in taxes here in Denver? Roughly a $500,000
That's a $500,000
home
property.
right?
Yeah.
So that's something that eats up. Is that money is going to the Nebraska budget, right? I know also insurance is more expensive in Nebraska. It's probably closer to about $1,800. And $1,800 in property insurance here would be about a $500,000 home. So that's one of the things that people don't realize is we look at, oh my God, it's a $210,000 property and I can rent it for $2,100 a month. Not this one, but as an example, must be a great deal. Don't forget about taxes and insurance. And I'll tell you where people get bitten on that when they're talking about out-of-state rentals is Florida. They forget about hurricane insurance. They forget about flood insurance. And those things add up. And property taxes, when people are looking at Nebraska, Texas, St. Louis,
Texas. Oh my
those
God.
things
Yeah.
add up. And that's one of the things that makes Denver, Colorado very beneficial is we are very tax efficient and very insurance efficient.
Great points.
I have a quick question to Ben. So one of our homeworks was actually to identify the risks and goals and write them down. So before we actually reply, like what we think you should do with your properties, what are your goals and your risk tolerance overall? And what metrics are important to you?
Alona, that is an excellent question. My goals is and you can read this in my 2022 chapter contribution, is for the Arvada rental, that's a current medium term rental. It's like the duplex in the skin of a single family home, is to sell that, use that equity for a proper multifamily in either the Springs or maybe even Pueblo. And then my goals is for the Omaha rental is to sell that and use that equity for house hack number 3, mid 2023 to late 2023.
So, Chris,
That makes
how
sense?
does that actually changes your overall recommendations for Ben? Does he's everything he just said, goals and like what he just described, does that change your recommendation to him?
I'm sorry. We were debating on whether Richard's portfolios there or not, so I missed part of that comment there. So I apologize.
All it was Arvada rental. Sell it, use equity for a property in the Springs or even Pueblo. And this is, let's say, mid 2023, 2024. So that's Arvada rental. That's the one that had the great cap rate and great equity into it.
Right. How long did you live there, though?
How long did I live there? Greater
than 2 years or less?
Less than 2 years.
Okay, I'm gonna say because that would make a lot of sense to sell because if you've lived in the property for 2 of the last 5 years, you generally get like capital gains exclusion, which is an amazing tax benefit from Uncle
Yes.
Sam.
Even after you've moved out?
Yep.
Correct.
Yeah. So Richard asked after you
I
moved
lived for
out.
a year and a half.
So
however, I refied.
Yeah, that doesn't
Doesn't
matter.
matter.
You have to
Okay.
live there. So you got someone here. When you want to sell their Arvada house, let them know.
Yes, I recommend you sell that property to me.
Yeah.
The problem is I'm not going.
I think you have a lot of people for that one.
Okay.
So, a couple other things I want to go on here. So, I would
When you
that it's very hard to go that forward on there. It just depends on the metrics. If it's still above a 4% cap rate, it performs very well. Maybe refi and keep it. Depends on interest rates, performance. It's very hard to say in 3 years do this. Reevaluate and see what the numbers say then. That would be my advice.
Yes, because a lot can change in 12 months.
Yeah. Oh,
That's right.
a lot can change in the last 5 weeks. Where were interest rates go 5 weeks ago, Joe?
I was giving away loans at 0%.
You missed it.
You didn't
Everybody
apply.
missed
No,
it.
what?
Contact me
No,
at Castle Cook Mortgage.
Interest rates have gone up roughly 0.75% in the last 5 weeks.
Yeah. I mean,
Things change. Absolutely.
So one other comment I want to go on here before we go around the questions is Patrick Brown had a very interesting comment, and I have no idea about the Omaha market. He says, Omaha has a pretty high number of homes for sale comparatively to the Denver and Springs market and easily can purchase rentals below $100,000.
Whoa.
Can I comment on this?
Of course.
One of my close friends runs our Omaha branch, and it's our second highest profitable branch in Castle and Cook Mortgage. And Patrick, you're exactly right. There is a pretty high number of homes for sale compared to Denver, and you can easily purchase rentals below $100,000. That's true. They do have properties at $80,000, $90,000, $70,000, but pretty high number of homes. Last week, they ended with 700 homes on the market. All right. Now, Omaha's a smaller city. I don't think it's even 1 million people, but it's still a very tight inventory market, and they're seeing a lot of the same things that we're seeing. And the downside is taxes, lower appreciation, and property insurance. So on the surface, it seems like a great market, but you're giving up some other things. And Patrick, know and love you. You always are great at finding markets. And I encourage everybody, if you're looking out of state, just make sure that you're looking at all the metrics and not getting tripped up.
So we got some other great questions on here. I'll come back in a minute to answer those. But to move on to the panel here, I'm going to give my answer last. I'm going to go left to right. So Joe, if this was your portfolio, would you keep Omaha or sell and 1031 to Springs?
I'm going to give a hybrid answer. I would wait, sell, pay the taxes, and use that money to buy your next primary residence.
Wait, sell, and use the equity to buy my third primary residence.
Correct.
And so then this won't be a 1031 exchange. Just bite the taxes and say it's cost of doing business.
That's correct.
Depends on where the down payment funds are coming from. Down payment funds are coming from. If you guys can save it from outside that, I would completely disagree.
You're welcome to.
Richard.
I would say get rid of it just because I was trying to manage stuff overseas and I have relatives in Denver and it was hard. I mean, I can't even imagine trying to do it, especially because not all property managers are reliable, even if you did have a property manager. So I dispose.
All right. So get rid of. Alona?
I'm with Richard on this.
So Alona says get rid of. Chelsea?
Yes, 1031. A couple of reasons. One, obviously to consolidate in state, but also to the points that Joe made. You're going to see better appreciation, better rent increases, in my belief, in a market here in Colorado.
So I agree. I would sell and trade up or trade out into the Springs.
It's almost a lateral.
Yeah.
And then hold on to and don't do anything with the Arvada property for the time.
For the time being, it's a great performing rental.
Yep.
Like you don't have any money you can really pull out from an equity standpoint. You could sell it, but it's so marginal equity.
Yep.
But give it a year or two, things will change.
And like Chris, you say one change at a time and
Yeah.
see how your portfolio performs.
Yeah.
What's your gut reaction?
I have a lot to think about.
I got to check with my wife.
Come on, I got the listing agreement here. I got a new property ready for you. What, we making a deal or not, Ben?
No,
No, we're making a deal or not.
Joe,
no,
pre-approved.
no, we're not.
You're pre-approved. What do you want to borrow?
I already know you're pre-approved. What do you want to borrow? No, I still like the thing that works because every one of you have your own different goals. I have my own goals. My wife and I our family have our own goals. We want our next house hack. That's what we're good at. We're good at house hacking. And I want to get rid of Arvada property because that's a lot of work because it's a short-term rental. We're doing the short-term rental management. Long-term rental, we're doing that management as well. Here's the thing about having a single-family home with a short-term rental in it and a long-term rental or a 12-month rent in it. Who's doing the shoveling? Who's doing laying down ice? Who's
The man that's talking.
the man that's talking? Exactly. I don't want to do that anymore. So now I put a dollar value to my time as well.
That makes me so happy to hear. That's super, super powerful.
I learned that through the people around this table. So I'm just copy. Yeah.
It's the power of the mastermind. So I got a counterpoint to you selling Arvada and to Joe's comment, all very valid comments, but I flip back to, can you bring up the slides again, Jules, for your Arvada property? So you said in a year to 2 years, you may want to buy your next house hack, right?
That is correct.
So I would say currently looking at your property, you're at a 68% LTV. My crystal ball says that in 2 years, you'll have a lower LTV. You're paying down debt, and I'm pretty sure prices will appreciate. So what you could potentially do is you could put a HELOC on the property, an investment HELOC.
You can't
Take out.
anymore. I've tried recently. They're totally cut off.
Oh, I've got some people for you to talk to.
Really?
Oh, yeah,
Okay.
yeah. Talk to me and Joe. We got you.
Okay, never mind.
But my point there is, you could potentially do that, pull equity, use that equity to go out there, buy your next house hack, then sell in 1031 and help to potentially avoid taking a tax hit. Asterisk, talk to your CPA, talk to 1031 QI, obviously talk with them, but you'll have options. So I wouldn't necessarily try to figure out the plan today for 2 years, but realize, hey, you have a buffet of options and so much dependent on the market and what you and your family do in the next 1 to 2 years.
Yeah.
Problem solved.